Welcome to Hot Stocks, live here with Paul Hill. Of course, Paul is an equity analyst, full-time investor. He never sleeps. He's always on the market. So the markets are open. In fact, even if the markets aren't open, Paul's awake. You know, fella.
Yeah, good afternoon, Justin. Slightly different timing for us normally, but it was important today because it was straight after the Bank of England decision of at 12 o'clock. In fact, I did see Andrew Bailey listen to what you've been telling him to do for the last 2 or 3 months, is the hold rate. So you got your prize.
Yeah, well, I was surprised at that. Like I said, we were covering it live, John and I, on taking stock, and I was expecting you think, as a sensible banker, economist, whatever he is. I don't know what qualifications he has, but you'd think they'd go with market forecasts. But those forecasts have changed, didn't they? And was yesterday, after CPI data came out, it was like the majority of people was going for a 0.25 percentage point hike, and then all of a sudden, after CPI data came out, 50-50 pretty much saying it's going to be a pause. And I think, what have they got inside information there somewhere? Why would you just change overnight on that data? I don't know if they did change overnight, but it was a close call, 5-4 on the vote, wasn't it? And the MPC.
Yeah. I think what's quite interesting, though, if you look at it from a macro perspective, we had the Federal Reserve making a similar decision the day before, and they've taken a sort of hawkish pause stance. But what they did was upgrade their economic projections going forward, and therefore they think they're going to hold rates for higher for longer. So rather than start cutting next year and end the year December 24 at sort of 4.5%, they're going to keep it to just over 5% in 18 months' time in December 24. So you've got the US economy really motoring, and therefore you're going to have higher rates and more restrictive monetary policy for longer. But actually, the reason for Andrew Bailey reducing, I'm pretty sure, is that he thinks is actually the economic scenario is much weaker this side of the Atlantic, which basically means that he's going to start having to hold and then cut interest rates probably sooner than most investors expected. And I know we've been sort of discussing that the last two calls, that effectively I thought that the interest rates on the States were going to stay higher for longer than the Wall Street were expecting. But I thought actually in the UK is suspicion that we will start cutting beforehand. So I can actually see, because unemployment's going up faster, certainly in the UK than it is in the US, then I can actually see, inflation's going to continue in its downward trajectory now. Andrew Bailey's going to get a bit of pressure from the government, from Westminster, because we're going to have a general election in November 24. There's going to be a bit of pressure for him to start cutting, and I can actually see him doing that probably around about March or end of the second quarter, sort of like between March and June, which will be sort of 3 to 6 months sooner than the market's baking in. And that will be good for obviously economically cyclical stocks, and obviously people like the house builders as well.
Yeah, well, I mean, the house builders we do quite well. That there, by the way, is on the chart. There is pound dollar. You can see last few months the pound has been coming down against the dollar. Yeah. And I you know what, this is a good chart. It's looking at just house builders had a nice rally, I think, last week, and this is like Gleason's chart, MJ Gleason, smaller house builder. And like I said, it hit the lows back in October here, also in January, December. And then it has been quite volatile, but even the previous lows have been higher than the last ones. And we've had so much gloomy news out on house builders that you'd think it would go lower, but it hasn't. And that's a good sign, isn't it? Very good sign. And so I'm thinking maybe Bailey, there's some kind of, it's a data point. I don't think it was that CPI data that made him change his mind. I think it's more like you said there, the economy is weakening. I said, they see a recession coming, and he doesn't want to be blamed for that. But that's what they're trying to do, essentially. Slow everything down. They need to. How can you slow everything down? How can you slow everything down without not going into recession when the GDP growth is minimal, if anything, isn't it? It's flat, basically.
Yeah, I mean, you put yourself in the position of Rishi Sunak and Philip Hunt, the Prime Minister and the Chancellor. Then they're going to have an election in just over 12 months' time. The last thing they want to do is start actually going to the hustings and trying to actually defend a recession or a deep recession. So Andrew Bailey, basically, I'm pretty sure now is going to hold and the economic data is going to weaken, and he's going to be coming under huge amounts of sort of like, nudging and pressure to actually start cutting early next year, and you'll start seeing that in the unemployment, no doubt about it, as people begin losing their jobs, unfortunately. So I'm with you. But the big picture is such that if we've reached a bottom in the house builders because they're economically sensitive and particularly interest rate sensitive, then I think we can go ditto small caps, good quality small caps. The multiples, you're going to see expansion of the multiples in small caps from extremely oversold levels to back to norm, to mean reversion. I don't think you're going to see huge amounts of EPS growth, as in increasing higher EPS outcome than actually built into expectations. But I can certainly see a big tick up in multiple expansion for the small cap. So for me and you, this could actually be a seminal moment.
Yeah. Well, listen, we are here live. To give you an example, is 5 minutes past 3, 50 seconds gone. And so if you want to ask us a question or Paul a question, because I know we've already got a question in, it's on a very popular stock, CEO of the company you've in this week, but it is about Avacta. And it's a very popular stock. But if you want to ask Paul any questions about stocks he holds or stocks he talked about previously, let him know in the comment section right there. And while you're there, hit that like and subscribe button if you could. But Jacob says, hi, given the news out on Avacta and the huge potential markets ahead of it, I'd like to know what you see as the key risks from here for investors. Now, actually, you had a chat with the main guy there. Is he feeling bullish, Paul?
Oh, absolutely. I mean, obviously they came out with really important and very exciting data for their cohort 6 and the phase 1A AVA 6000 chemo warhead clinical trial, basically saying that the safety profile is absolutely top notch. In fact, it's so good they're going to a cohort 7 to get the maximum tolerated dose. But also, and this was really incredible, they started to see that efficacy was also was working, and they had one particular patient, very sick patient, with soft tissue sarcoma that saw a significant, and this is what he said, significant shrinkage in that tumor. Now, what that means to me, and this is what he said as well, is essentially the whole precision platform and the the FAP activated drug, etc., is working absolutely as it's designed. It's not only stopping toxicity getting into the healthy tissues, into around about the heart, but it's also actually starting to shrink tumors. And I know it's only a small sample of 35, and so one of the big risks that I would say is that when you scale it up to phase 2 and potentially phase 3, and you get to hundreds, then you might start seeing other issues come forward, etc. But assuming that's not the case, then this is absolutely out of this world. It's better than the company expectations, I'm sure, when they went into the actual trial, to not only get significant safety, sort of like data that is frankly leading edge, but they're also starting to see efficacy coming through as well, and that really does set it up for the phase 2. In fact, what it means is that because they're in such a good, confident, and strong position, they can then just do a small additional study and skip the phase 1B they'd already planned, saving time and saving cost, for the actual for the business, and hopefully bring the actual drug itself to to patients who desperately need this treatment sooner than they're anticipated. And I think they're aiming for to start the pivotal phase 2 trial the back end of next year, which will be split between the US and the UK. And what is really, really exciting, Singers have put a note out in terms of what they think, the valuation of the business, and I think it's just over £1.50, etc. But that's a risk adjusted, and if you look at it, they've got, I think it's a 37.5% probability that AVA 6000 makes it to market. Well, actually, that could be a lot better than 37.5%, given what we've seen so far. So you literally, if that comes to market, you're well over double that target they put down, and that's just the one drug. They've got precision. They've got there's a whole host of others they could do for different existing chemotherapies that are FAP enzyme activated with other tumors as well. So this could really be, again, it's game-changing results, no doubt about it. The thing is not to get too excited this early, but it's looking really, really good. Not only, for the actual product, for the AVA 6000 and the precision platform, but also for patients. The outlook. I mean, these are desperately sick patients that, frankly, have no alternative other than, unfortunately, they're going to die because they really are in desperate need of something that's going to be able to help them get through it, because they've probably got metastatic cancers, etc. And this could well be, the platform that helps them do it affordably and across the world.
Yeah. I mean, I said, the data so far is very good and it's very encouraging. But I mean, and what I love about investing is you learn about sectors. You learn, before I started investing, I knew very little about clinical trials, but I've looked at them and read about them, look at the stats on them. And like I say, phase one, pretty much, it's about safety, and that's the most important thing of all. Can patients take this drug without any adverse reactions to it, effects to it? They're killing people essentially, and it's less than 50 people. But as it goes along to phase two, the amount of patients goes up and the risk goes up. But of course, if you pass those, then the valuation goes as well, because the potential getting to market is higher. And then phase three, I mean, I'd say if you look at the stats, very few companies fail on phase one, but quite a few fail on phase three, because
this is where it's really
thousands of people, or even several hundred or thousands of people, and so it's very costly as well. It's a lot more complex. It's about beating market competitors out there and all that stuff. So
this is what's really interesting. Yeah, we know that the standard doxorubicin, because this is pro-doxorubicin, it's a pro drug format. The standard doxorubicin, it's been in operation. It's not patented anymore. It's been used by patients in chemotherapy for 30 years, 25. My mum used it basically, and it didn't work because, unfortunately, the toxicity, she had to stop because it was killing. But we do know it knocks 10 bells out of cancers. It just unfortunately knocks 10 bells out of health tissue as well. So so efficacy is not the issue with these chemotherapies drugs. It's just side effects. Okay, and that's the key. So when you're on your model, you go from safety, ticking the box on phase one. They've actually got some very good efficacy data as well. Phase two is the pivotal efficacy study, and it's going to be on obviously more patient to see whether you are actually seeing a significant shrinkage of the tumor without causing any more side effects on more on people. We haven't seen any significant side effects at all in any of them. So that's been absolutely brilliant. And therefore, phase three, it obviously depends on what the regulatory authorities want to do. But we know, doxorubicin is very, very, effective at what it does. What it says on the tin, it's protecting the patient. And if you've demonstrated that in phase one and phase two, then you're probably not going to have to do a really long and really advanced study in phase three, and that may well be accelerated. So the risk from the traditional model, because you're using an existing drug, is a lot lower.
So the safety profile is well known, I suppose. Okay, and just chart wise, it's looking quite good. It's gone up above that 200-day moving average, and it hasn't that for a while. Like I said, that level there does seem to be a very good support of that sort of pound level, but it's lifting up this nicely. So
let's be clear about it. Yeah, there's masses and masses of big cancer biopharma companies out there, just Novartis, Roche, GSK, all these kind of guys, and some of them have really big sort of chemotherapy franchises, etc. Now they need to replenish those pipelines. All I'm saying is that if they can get good data by the end of this first phase, then that gives them a huge amounts of optionality about what they want to do. Then they can either self-fund it, and if they're getting a lot of interest from commercial big pharma who want to put a lot of money into it, they could obviously use some of that finance if they want to, but it's their call. Now you could also see, and this is what you talk about the share price, it wouldn't be surprising that if we as laymen are looking at these results thinking they're absolutely tremendous, then you can guarantee the best scientists in the world are also looking at this, and they won't want somebody else buying it before they get a chance to put a number on it.
Yeah, but maybe they would. I assume. Like the thing is, when like the partnership, it's a very well known model. You know, what you do is prove out as much data as you can afford to do with the time you got to do it, and then de-risk it for bigger pharma companies, and then they come in and will snap it up. Or they'll. In fact, a company I hold, like I said, Destiny Pharma, got the interims this week, and the new CEO stepped in, Chris Tovey, who's a very experienced guy, and he basically said, the reason why I came into Destiny Pharma is because I've never known these assets are fantastic. They serve a huge unmet medical need in serving people all different sort of diseases and antimicrobial resistance. And he said, last time I was in a company like this, in fact, he said Destiny Pharma is better placed asset wise than GW Pharma was when I started there. And it's 6 months after he started GW Pharma, he was taken out for 7.2 billion.
Yeah.
So it depends. And in fact, let me just share the screen. If you look at that, the phase, they've got like phase 2, they're going to phase 3 for their, it's a big drug, $2 billion US market opportunity there. They've also got M3, which is in phase, going to phase 3, and that's funded by pharmaceuticals. And that's what they did. You take lots of data up until phase 3. Phase 3 is very expensive, and then you partner it with somebody else. But they've also got this pipeline here, which is, thing. But I was really impressed. I did watch his interview. Hopefully he's going to be on the podcast very soon, Chris Tovey. But really impressed with him. And it's funny. He said, why? Someone did ask, why have you come to Destiny Pharma, a microcap? And he said, well, essentially because the assets they have. And so it's very thing, but
well, I mean,
it's good.
I mean, one of their partners could buy it if they get good results. It wouldn't be a stupid decision, would it? Then they've got all the clinical data, and therefore they can price it and put in the relevant risks associated to getting it final clearance. Then they could be a very attractive asset for a much bigger pharmaceutical company that needs growth.
Yeah.
One thing on the just on healthcare, etc. I know, do you still own Intelligent Ultrasound?
Yeah, everybody just bought them.
Okay, yeah. Well, I was going to pick your brains then.
In fact, someone did say, by the way, this question here, Steve said, Intelligent Ultrasound could be an opportunity. I've done my own research and agreed. Just wondered if you could share your thoughts. Thanks. Go on.
Great,
my brain.
Well,
I may not know the answer.
Yeah, well, the question that I had, which came over the news wires this morning, so I'm hoping you've seen it, but you may not. If you haven't, I'll send it to you. But GE Healthcare, have just got a $44 million grant from Bill and Melinda Gates Foundation to develop AI ultrasound technology to help sort of third world countries, to improve they don't need, sort of so expensive doctors. They can go ahead with it. Now, what the question is, I mean, that should be, in theory, very positive for Intelligent Ultrasound, because that means that, essentially they're getting their customer who's developing, effectively helping to develop Intelligent Ultrasound's AI capability, is getting 44 million quid, $44 million to be able then to accelerate it. So I was just wondering, it seems positive to me.
Yeah, well, it's got it there. So 44 million.
This
is wow. They're just going to buy Intelligent Ultrasound, aren't they?
They've got $44 million now to do it.
I know. This is very funny because, like I say, they 3 of the machines. They've got 3 products now, Intelligent Ultrasound, that have AI, and they've got 37 million images they use backed up from that. They've been developing this for over 5-6 years now. So, and they are, they're a leader in this field. This is why GE pretty much uses them and uses their products. So that's very interesting. Yeah, very. No, I know.
Yeah, no, that's what I thought.
But so they're going to be, and what I like about it is like their steady sort of backbone to the business currently is seminars, and they teach people how to use ultrasound machines in simulators, and then they follow them through the clinic, and obviously they sell into the clinic as well. But the AIs, so the backbone, the simulation business, is doing around about I think close to 10 million in revenue this year. And they say, but in a couple of years' time, that'll probably be doing sort of 12, 13 million. But the AI side will also be doing the same. Now, when you understand last year, the AI side only did 300,000, but yet they're still, they're still monetizing AI even like last year. It's doubled to 700,000, and it'll double again, and it'll double until it gets to 13 million again or 12.5 million by 2025, because they now have the AI products in 3 products, which they didn't before. It was only 1 product, now it's in 3, and they're increasingly using it. Like GE accounts for 50% of the world's ultrasound machines, so you can't get a bigger customer, so it's huge for them.
And also the thing is this grant from Bill and Melinda Gates Foundation is targeted at low or middle income countries. So what you're doing is actually, because you've got that AI, intelligent layer over, helping assistants and doctors diagnose and to treat, patients and people obviously who, going through labor, in the maternity wards, etc. Then what it's doing is that you're increasing or expanding the addressable market hugely, because you've got so much of the world who can't afford this technology still, unfortunately. But with this particular bit of, overlay of AI, it allows them then to start using this leading edge, medical science. And so you're increasing your global market for ultrasound. So it's got to be positive. It's got to be a win-win either way, I think.
Look at this, right? Look at this. It's here. So it says grant from Bill and Melinda Gates Foundation with less experience to perform quick and accurate ultrasound scans to help address maternal and fetal health respiratory. This is essentially, that scan nav is that GE's. This is Intelligent Ultrasound. That's their website, and that's GE using it. So that's phenomenal. Yeah, wow. That's
breaking news, then, I suppose.
Yeah, breaking news. Yeah. Now, hopefully the share price goes up, but there we are.
I know you have to buy some more. But anyway, I mean, that's public information, because it was done on the 18th, wasn't it? So 2 or 3 days ago.
Yeah. Okay, someone says, by the way, hVIVO, have you been looking at those? Because someone did say it seems to be steadily climbing over the past few weeks. Good to see a little bit more trading volume as late. Thoughts on progress and the company itself will be useful. I am invested. Dave, that is Dave. I do like.
I'm in the same party as John. I'm a big fan. Yeah. I don't own shares of hVIVO. But this is a very much a sort of captured market. People think that it's easy to replicate. It absolutely isn't, because you've got to have really strong, sort of like procedures to make sure you get the right dosing regimes for people. And, they don't just give out, the authorities don't just give out licenses to people to do, vaccine challenge trials, because it can be highly dangerous. So this has to be a very controlled environment. And, from what I've, a number of fund managers I've spoken to, they really sort of rate the CEO, who's done this before as well, with regards to contract research organizations. And I don't know. I mean, it's difficult for me, but I would say the path of least resistance for the share price is going to be up, because this is only relatively a small company, but in a huge market, and vaccines are becoming far more important as a form of therapeutics and treatment. Just look at cancer, the amount of vaccines now being, and that money being piled into it, from Moderna and from Pfizer, to be able to do that, because they realize one of the best ways is to use your T cells to be able to attack the cancers and shrink them. And these guys are going to be right in it.
Yeah. Well, look at that chart. It's a nice looking chart, that. I mean, if you look at the red line, just a 200 moving, let's take the 50 off for a second. But if you look at the 200 moving average, and you see it's just downtrend, it breaks that literally, be careful of fast rises. They can get sold into, like there's there 21st of November, got sold into there, but then it picked up again. Another fast rise can get sold into, but now bounced back on the 200 moving average. It's using that as support pretty much, and now it's rising up nicely. And I steady climb, so that's quite nice. And John, owns some of these, and he said it's John likes the areas of picks and shovels of big industry, and it's very clever because they'll always have work. These companies, if they're good, they'll always get work. Like I said, you can go for the sort of the sexier end, which is actually creating kind of vaccines and all that, but that's high risk. But these guys will always be in work, and like I say, if you're very good at it, that they are, then I mean, look at that. Nothing's not like there. Revenue grew 52%, EBITDA more than doubled. Even net cash got up to 31 from 15, and contract book 78 million.
Yeah. I mean, picks and shovels models are great, no doubt about it, because you're not betting on any particular person winning. You're going to win anyway, But what I really like about the business is that the demand is off the charts, and it's so much so they're having to bring in new capacities. They've got that, they've just raised some, or they've got some money to basically put on a new facility and bring extra beds to be able to do these challenges. So demand is just not an issue. Demand is off the charts on this, and you can see that coming through. The only limiting factor is capacity, which is great.
Yeah, exactly. Okay,
another one in exactly the same boat, is Belluscura. I know we've talked about that. They came out with interim results, but essentially, big picture, the shares have sold off a bit because it's going to be more second half weighted. But essentially, investors should look at it, and these do, the portable oxygen concentrators that help COPD patients, etc. But essentially, they've got FDA approval. They've got best-in-class distributors, like McKesson. They've got established supply chain in the likes of, China and locally manufactured in the States. And the demand here is off the charts again. They've got a new product coming out very shortly in Q4 or next month or so. The Discover portable oxygen concentrator. They're taking, we know, $15 million worth of new contracts. You've got Inomax, their partner out in the States, which is a subsidiary of Foxconn. They've actually got a license, for exclusive of $55 million. I mean, that's the key when you come to this sort of really proprietary and sort of in demand technologies. Do customers like it? And they don't just like it; they absolutely just can't get enough of it. So the issue for hVIVO, but more so for Belluscura, is going to be execution and meeting that demand. So it's who knows, but all I can say is that the product is fabulous because very, very sensible and professional people in the industry are signing up and they can't get enough volume. So that says to me that this thing is their product is definitely state of the art. And the same is with hVIVO. They just aren't. It's literally, you've got a shed load of customers trying to buy from one party. So it gives you huge confidence and revenue visibility as long as you can deliver. And that's where basically now they've got the supply chain in place and the distribution partners to be able to get that.
Yeah, do you know what,
2024 is going to be an inflection point for the business. You mark my words.
Yeah. It rallied quite strongly. It's back, there. But I mean, there's six higher lows there. I can't stop thinking about that Intelligent Ultrasound.
No, sorry about that. I should have said it at the end, shouldn't I?
No, but because I just think, GE, as use their AI technology. I mean, if they're going to submit a way of, spread that around the world in an affordable way, they're not going to create, technology themselves. They're going to sort of obviously get in contact with the best people they know, I suppose, they're contracts with. Who knows? Anyway, but that's very bullish.
All I would say is that your thesis is spot on there, Justin, because Bill and Melinda Gates aren't stupid. Okay, they don't throw money around, and if they believe that GE AI, GE Healthcare AI system is powered by Intelligent Ultrasound is the one to go for. You can get gives you a lot of sort of confidence. But I would say that needs to be confirmed by the company, and it's still early days, because if they've only just given them the grant, then that will have to come through in the fullness of time. It isn't as though it's anything announceable in the next few weeks, because they won't see that because they've probably only just got the money.
Yeah.
But it's got to be positive, you'd have thought.
Yeah, talking about healthcare, someone did say about Totally PLC, and they've had a horrendous time. I mean, the chart here, as you can see, it's come down. And they did say that expectations are going to be lower in a statement recently. And it's hard. The NHS is hard going. There's cuts going on, but they're the front line there. And results. I mean, turnover thing, revenue up 137 million. This was to 12 months, 31st of March. They did give a bit of a profit warning, but nevertheless, they're profitable. And so, EBITDA 7 million. But now the valuation on these, they are a dramatic cap of 15 million. Yeah. When you get companies so oversold like this, I mean, sentiment drives and sellers beget sellers. And regardless sometimes of the value, people just get out. And that can present some great opportunities. But someone's asking about
I hadn't been following them, but you're exactly right. I mean, I've spoken to Wendy Lawrence a couple of times, the CEO, and she's absolutely terrific. I mean, she comes from the healthcare area, and I'm not sure she's a doctor, but she's certainly best in class when it comes to sort of the servicing the NHS, and Yeah, I mean that looks a ridiculous price to me. And let's be clear about it. A lot of the difficulties they've had, I think, has been recruitment and getting the right number to be able to help the NHS. And if we do see a slackening off in the labour market, then that will actually it's just a transitory, in inverted commas, issue, and therefore in the fullness of times it will come through. So there's lots of companies are going through some difficulties. But the share price is pricing them to death, and this isn't anywhere near it. It absolutely isn't anywhere near it. It looks like a crazily low multiple for a business that's a bit of essential infrastructure for the NHS.
Yeah. No, it's literally. I've been watching it late recently because I put chart alerts on, and it's been ticking down and hitting those alerts going further down. I thought, wow. And so it is one I'm just watching because you do get these companies, they can have a really aggressive bounce when people realize they're oversold, and that's ridiculous. And people start piling in then. But that's the market, isn't it? You get this point where you can't avoid the opportunity sometimes, and you have to buy a couple of shares. That silly price. But keep an eye on that. It's a good company and worth looking at. Massively
you mentioned about sort of interesting management changes. Well, at Saietta, we've talked about that a few times, but they've had a management change this week. They've announced a new CEO coming in, industry veteran who's spent the last sort of 6 years really, deep diving and working in the decarbonisation and electrification field. So he's coming on board. A guy called David Woolley. And I mean, what that says to me is you've got an industry veteran of 35 years who really knows what he's doing. He's kicked the tires. He's done due diligence on the company. He's obviously very impressed with the business and what it's trying to do and with its technology. And he wants to join and drive it forward. So there's a lot of sort of like reassurance that investors can take from that. Saietta is actually having its I think it's got an AGM next week, and therefore their prelims should be coming out, or their FY23 results should be coming out fairly soon. It may not be before it, but it'll be certainly by the end of September. So something for investors to watch out for. But I would say when you do get a top leadership change, then and you bring in a real industry heavyweight into the business, that does say a lot about the quality of the company, even though the shares may have sold off. And this is another one.
Yeah. I mean, they come down there. They keep hitting themselves in that 50 pence level. I think once you get above that, I think literally you can see here, it's a nice line. Even going from here, you can see higher lows there. And once it gets above 50, I think it's in an uptrend here. But
there's lots of big value catalysts coming there, because the production is just about to kick off in India with Padmini, with the VNA joint venture there. And once they start getting those e-drives off the production line into vehicles and into the public, into India, that will just make a huge sentiment change for investors. It will go from being sort of like early stage to really sort of fast tracking commercialization, because the EV vehicles and that industry in India is electric. Sorry.
Yeah. Hey,
bum.
There's one here talking about what do you say? Seems like Cake Box is a buy from your recent interviews and videos, Paul. Cake Box.
I'm keeping my eye on it, no doubt about it. And they've had a bid on it at 160. It was rejected because it was too low. What's my view of the consumer? I mean, I'm not an expert in consumer. I don't do particularly well when it comes to investing, but it certainly seems as though people have normalized in terms of getting back to celebrating their birthdays. It's an affordable treat, and the product's fantastic. My family's used it twice. He had got the big cake in for big parties, and it's great. So I mean, who knows? I mean, it's difficult to say, because I'm not an expert and that comfortable in Cake Box. But the franchise model, capital light, still growing, good margins on a cheap valuation with lots of cash and potential M&A interest. I mean, I'm not sure what isn't there to like there.
Yeah, and of course the main guy has a lot of skin in the game, doesn't he? He's bought.
Yeah, it does. Yeah, Suk Chamdal. Yeah. I wouldn't be throwing away that one. I mean, another one which is coming out with important news next week is Avingtrans. They've got the prelims FY23. They just mopped up, or they bought the 82% of Adaptix that they didn't own. This is part of their sort of fledgling, fast-growing healthcare division. They've got they're famous, obviously, for niche engineering with sort of blast-proof doors and nuclear safety storage boxes. But they've also got this healthcare business that's doing small form MRI, but Adaptix does small form X-rays, and they've got FDA approval. They're launching at the moment out in the States, and now they're 100% subsidiary of Avingtrans. So I'm hoping to catch up with the guys there and try and dissect what they're doing with that. That could be a huge third growth platform for the business, and I think it will be, no doubt about it. They've got plenty of money, so they can fund it. Really isn't an issue. It's going to come down to, again, execution. And I think what will happen, actually, small form MRI and small form, X-ray, if you start seeing some significant sales, somebody's going to put a number on this division and buy it out at a big premium. And then they'll basically either reinvest that money or alternatively give it to shareholders. So these guys have been, doing a great job for 20 years. The shares have, or certainly from the great 15 years or so, the great financial crisis, the shares have gone up by over 20% compound each year, which just says everything. They know what they're doing. They're a really successful management team. And anyway, I wanted to highlight that to investors because, if this one ever falls down, which it hasn't done in terms of, being sold off because it's so high quality, you just got to fill your boots.
Yeah, it's literally, it's since 2009, pretty much 2010, it's on 1,200%.
Yeah.
In growth, and that's a weekly chart there, but yeah, that's quite impressive.
I think there's too many people when it comes to sort of opportunities to buy this. I just think there's too many really smart investors who it's on their shopping list. I'm pretty certain Christopher Mills at Harvard would want to increase his stake. James Thorne at Columbia probably would want to increase it. Never mind a whole bunch of other people who just see value as a potential upside for this business.
Yeah. In fact, Steve says, Paul, if you get time, it would be great if you could do an interview with CEO Totally. Thanks for your comments. No,
absolutely. Well, there's always an invite. Wendy's a great lady. I love her.
Yeah. You just repeated. Sean's repeated. Just joined and missed. You can rewind. I think Sean is an avid fan of Avacta. But he says,
I mean, I think the big picture with Avacta, is that currently, the Singers have a price target on a risk-adjusted basis of 154. If AVA 6000 becomes to market, they'll take away that risk probability, and that will double the shares from their valuation to £3. Okay, that's just one drug in that precision platform. I mean, effectively, it's going to be who knows? You can never sell, but there's huge upside in this business. And I am now more confident about the safety and efficacy of the AVA 6000 and the precision platform than I have ever been. And I've been positive about it in the past.
Yeah.
But it's not without risk. As we talked about, when you scale up through the phases and trials and you go to a bigger population, you may, and they haven't seen it yet, you may have a blind spot. Nobody knows. Or there may be a hiccup, a delay, or whatever it is, because these things are not certain. So, it's not something you could ever say is a slam dunk because they just don't exist.
Yeah, no, exactly. Well, it isn't. If you look at the stats in oncology, going from preclinical to commercial, it's like if you're including oncology, it's 13 to 1 chance.
Yeah.
Now, if you put your money on a horse at 13 to 1, all your money on it, or you diversify a bit and say, I'll keep a bit of money for other horses maybe. But but once you get past phase 1, that goes down. But of course, that's an average, and some drugs are different to others. But and all you need is, like you say, it seems like an excellent product. Phase 1 is blowing out of the water there. Really, it has. But like you say, when you get to sort of 1,000 people compared to how much was in phase 1? Do you know? I mean,
it was 35 patients 35, so far.
Yeah. When you get 1,000 people, all you need is 1 or 2 adverse events, and and that's.
And then you can delay it until you prove that it isn't nothing to do with the drug. It's just because of that. I mean, the thing is to remember, these are really, really sick people. There's no alternative. Unfortunately, if they don't get a treatment, and they're going to die, and they know that, and that's why they're on the trial.
Mm-hmm.
Anyway, let's I don't
know. Any other news?
Well, another best-in-class company that is worth watching it, because they've been unfairly sold off in mine, is Supreme. Now, obviously there's been a lot of sort of controversy surrounding that whole sort of underage vaping and also disposables with the environmental side. Well, we've talked about it before, but Supreme not only has sort of best-in-class regulatory compliance in terms of, going around spot checking some of the retailers for underage, making sure they're abiding by the rules, and checking that the ingredients and the content of all their products is right even from the third-party distributors. But also the key news is that they've now upped that on the regulatory compliance and being sort of really leading the industry as a thought leader in this. They're just about to launch their new reusable vaping pod 88 vape, and this should certainly sort of like it leads the industry, because it basically what it means is that you reduce the environmental footprint of the actual division. And the trading's absolutely in line. So the shares have gone from about 130 to 90p, or just over 90p on the back of that news, and that looks to me totally unfair. So I think there's an opportunity there.
Yeah,
I can't remember. I'll have to look at the PE, but I think it's roughly around. Just looking profit, at it, PE is less than 7.5. I mean, that is a joke for a business with cash on the balance sheet and growing, a rate. So and is leading the market in effectively compliance and safety and underage, all that kind of stuff, all the stuff that the government wants to do. They are leading the industry in it. Basically they're getting unfairly thrown out with the bathwater.
Yeah, I know that. John and I talked about this a while back. So when you have a company that welcomes, government, backing support, and open to chatting to the government, sort of supporting the negative side of it, that's good. And they said that they welcome that, I mean, the chart there, it is taking a bit of a hammer in it, but it is bouncing off after getting oversold down to here. Like, that's a good buy at 70 pence, but it is bouncing off that 90 pence level. Even after that, in response to media, it's hitting that 90 pence and bouncing back up. From maybe it'll flatline and start building. Who knows? But
I mean, and also you've got to remember that basically, the NHS is handing out 1 million vaping devices to get people off smoking. So it isn't as though this thing works. It's so much more, helpful in terms of people's health, etc. So, in that respect, and it's been demonstrated that vaping is twice as effective as any other form of tobacco, of nicotine, to be able to get people off tobacco. So better than, twice as good as patches and gum and all that kind of stuff. So that's why the NHS is using it. They wouldn't be doing it otherwise.
One of my stocks had some results out recently, Good Energy, and
how did it go?
Well, it's good, but it popped up, but I think it's a little seller in there. But I genuinely think I hold different stocks for different reasons. But I mean, for example, Destiny Pharma there, I genuinely see is one of the best reward stocks. There's risk there, of course, because going through clinical trials. But as a risk reward, weighing up that, I think this is one of the best ratios here with Good Energy. I mean, if you look at the risk profile on it, I mean, here's the interim results. Now, it's a bit skewed to H1 because of payments for electricity support and all that stuff. But let's go to the market cap first. 32 million, okay? 32 million market cap. Keep that in mind. 32 million market cap, okay? Cash and equivalents of 34.9.
Okay, the question, Justin, on that one, okay, which
that
I don't know.
A bit. Yeah, go on.
The question is that distributable, or is it basically customers paying them deposits on a 12-month deal that bank that profit, and therefore that covers them buying the gas and electricity for their customers over the next 6 months?
Yeah, about 8 million of that is that restricted cash. 8 million of that. So they have around about 19 million, but the net asset value, like I say, people are not aware of that. If you broke the company down and sold it off bits, you should get about 50 million. And literally, the profit also went up in H1. They're going to be making a small loss in H2 due to the change in the margins and government support and all that stuff. But nevertheless, they will be profitable throughout the year. They're paying a dividend. Okay.
So the next question then. Okay, so 8 million of that 35 is effectively customer deposits, right?
Yeah.
Do they buy forward their energy?
Yes, they will buy. They've already hedged, so they're about 90% hedged, I think.
Okay, and how much do they need to post as collateral with the traders to be able to get the assurance of that energy they're buying?
Well, I remember speaking to the CEO Nigel, and he said, "Really, we have about between 10 and 12 million in cash that we can do what we want with, and we're saving that for like acquisitions. And
okay,
also,
that makes
and
sense.
also
Okay, so what we're
dividends,
saying then is essentially with is it 30 million market cap? You've got
32
about
million,
about their available cash. You've got over 10 million, a third of their effectively valuation, which is just they could distribute it if they want. That's what you're saying, isn't it?
Yeah. I mean, the revenue growth. This is my spreadsheet I've done. The price sales. It's the value here. They are now. The only thing that's concerning is efficiency, the margins, but they are going to an energy services business. They're not going to be, because there's no margin in supplying. If you own, they did own assets like wind farms, solar panels. There's a lot of capital expenditure with those. There's a lot of maintenance, and they had debt with that. So they sold those off. They now got power purchase agreements with Ørsted and also 1,800 independent energy suppliers. And go to the website. The lovely story about these suppliers from the Welsh hills, where the hydropower farmers or husband and wife put this little power unit or a solar farm attached to a winery in the south of England, and they have 1,800 of those plus power purchase agreements. They supply that, but they've also acquired a solar business and a heat pump business. And they did say actually the heat pump business isn't growing as fast as we'd like yet, probably because the capital expenditure is quite expensive. Then Rishi came out with this rolling back the 2030 deal, and he's upped the amount they'll give you on a heat pump from 5,000 to 7,500. So that may even help them there. So, because it is quite a big spend, isn't it? A new boiler, whatever. So now you get £7,500 up front. But like I said, it's come down. Their biggest shareholder, like I said, offered £4 for them back here in 2021. It's still their biggest shareholder. But they did pop up. Like I said, they're up to 220, which is quite nice. They're above that 200 moving average now, and these are curving up. So hopefully we'll see this going forward. But going forward, the margins improve. The top line comes down a little bit, not a lot, but you understand the margins improve a lot. And so I think the broker has a 475 target on it, and that's 7 times EBITDA 2024. So I just think it's going in the right direction. And regardless of where we've moved from 2030 to 2035, it's inevitable. We are going to a more clean, green environment, and just people in the end. I don't know what it is, but people will be driving more EVs, and they will. And as a they own ZapMap as well. 49% of that. That's the most used, charging point map app on I think like 80% of the market they've got in that. So it's just I quite like the space it's in. I quite like the valuation. I don't think it can go down a lot further unless they do something really stupid, because it's underpinned by the net asset value pretty much, and the cash, and the profitable pay a dividend.
Yeah, no, I'm with you. I actually think that whole sector is hugely sold off because it's no touch for many investors, given what happened at the start of the Ukraine-Russia war just before it. And as energy prices ballooned, people lost faith. It's a bit like the contractors businesses, with the likes of Galliford Try and all these other ones sort of a few years ago. Once you've got this sort of like they're not sure, that don't fully understand the business model, then you get sentiment going off. So you're right. This is probably just unfairly sold off on sentiment.
Yeah. No, so I just think it's one of the best risk reward plays out there, because we often we tend to look at everyone likes to look at the reward first, but don't think about the risk.
Well, I mean, we talked about it last time. I've had 4 profit warnings of late. I had Inspiration Healthcare, I had Essensis, and even Bristol Myers Squibb came out with a profit warning in the last results. But the big one was obviously Sondrel, and they came out with their numbers actually today. The shares have gone down a bit more, so they're about 15p. It's all to do basically going into next year. You can just see it there. I did have a quick
read, and the thing they worry about, I mean, is it the cash level they had?
No, I'd say you would, exactly. The cash level is very thin at the moment, should we say?
No, I'll go back to the chart.
I've got far more than that in my broker account. Never mind what they've got in the business.
Well, ask them. Say, how much do you need?
I know. Yeah,
that's
exactly.
The thing sometimes, isn't it? You think, how much do you need? Let's have a whip round.
I know. Yeah, but okay, right. I did actually touch base quickly to the CEO this morning, right? And they have. It says in the statement they've had 2.5 million. As a cash injection, well, basically a payment from one of their customers. It was delayed, so that's come through. So they've got effectively about 2.5 million, net cash at the half year now. If you see what I mean, but they had a cash burn in the first half of about 3.5 mil, about sort of 600 grand a month, which means that they're going to be, go back to be probably zero cash at the year end. Now, They have got some milestone payments coming in from a big OEM automotive, which hopefully should tide them through. And they've got some really positive sort of chip design contracts. That again should be CC milestone payments and production. The problem they have, unfortunately, is if you have any delay in any of those cash flows coming into the business, you're going to get a bit of a hole in your bank account. And so I don't know. I really don't know. I mean, they've got certainly no intention of raising any money, as I understand. They don't need to, because the cash flows are going to cover it. And they said that in the the directors have, vouched for that in the going concern statement. But if you do get delays, they probably haven't got too much amount of wiggle room. Now, what would be the course if they do need more, money? They might well be able to get vendor finance on some of their debt, because we're talking about the big customers here, big OEMs who owe them money, and therefore they might be able to get some, some working capital trade finance on the back of it. That's fine. Lots of people do it. In the event that they can't do it, then you're probably looking at a convertible, or alternatively, an equity raise, one of the two. I can't see too many banks giving them an RCF. If you're not making profitable, but they should be profitable next year. That's what the brokers are saying. They should be profitable on the similar type of turnover for next year that they should have done this year. So coming big picture, it hasn't been my finest hour. It's probably a fair reflection.
Well, hang on a second. Let me just say one thing. And Sean, if you're still watching, he's a big fan of Avacta. He has most of his funds, if not all his funds, in Avacta. And I've said, shouldn't do that. Things are dead certain in life, especially investments. But, and this is a lesson. So you've had three companies, what, within
four in about 4 weeks.
But it don't matter, see, because look at this performer. You've had Equals bought in an excellent time. It's now taken up a third of your portfolio. So when you understand that, let's say for example, you have 4 companies, and you've gone. I don't know how big you went in those, but this is a double, triple your money on this, and so that's still like net.
Okay, well let's go through Equals, right? I started buying it.
Broke up nicely.
I started buying it just about 2.5 years ago. It was basically just after the pandemic hit. So around about, I think it was May, June time of 2020. Okay. So I think I had an average buy price of roughly around about 27p or something like that, of that order.
Yeah, that's it. Yeah.
So it was about that sort of level anyway, or 28p, I can't remember. And I haven't sold a single share. They came out with their interims this last time. They've just done 43% like-for-like growth, top line. They've increased, importantly, their gross margins to 52%, and they've generated an enormous amount of cash. So this is a money-making machine. That is just in the UK as well. They've just bought this business in Belgium, and they'll take time to lift and shift their bank-grade technology over there into the EU, but next year again is going to be a huge inflection point. The market opportunity in Europe is much bigger than it is in the UK, and they're winning effectively huge customers, large customers. That's what's really driving the growth, because of effectively their bank grade technology, and you can see it happening again. Next year could be a really big moment. So, what do you do with something like, with my holding? I've tripled my money. Okay. My wife is losing sleep. I'm my nerves are
is that
frayed.
The same reason? Why is she losing? Oh, is she losing it? That's funny. Is she losing sleep over you? Because you got such a big position in this, or
yes,
because you're getting a bit,
Yes. So to keep my marriage on the straight and narrow, I've actually taken a third off. Okay, so I've top sliced. So I've dropped my position from 30% of my portfolio to 20%. It's still by far and away my biggest holding. I am still really positive on it, but now I'll be able to sleep a bit better at night, and my wife will stop throwing rocks at me. No,
I genuinely think when you're in that situation where a company whole, takes up that size of your portfolio, and you're always thinking about it, and every movement you're looking at, it's not comfortable. You've got to ease up a little bit, and I think that's your brain and mind telling you need to unload a bit.
Unwind, exactly. And it doesn't owe me anything at all now. The rest to go is running for free. And I am really positive on their business because the momentum top line is enormous. The opportunity is bigger than it's ever been. Their bank grade technology is no doubt about it, is best in class because and the evidence you can see that is that they're winning so many large customers who want to now use the system. They just wouldn't be going with effectively equals. They'd be going with one of the large banks or one of the big players, the other big, sort of fintech providers, but they're not going with equals because they give them the best combination of value, service, and geographical spread and speed of exexecution. So they're doing really well. They're really
they are doing well. I mean,
team.
I often walk the dog and to listen to this the business podcast. I was in the Sky the other day, and Ian was on there.
Was he? Okay,
I know Ian myself, so he's on Sky, Business News. So they're doing really well there. I mean, look at. You can't fault those triple digit, double digit, and
But look at the gross margins; they've gone up. So they're winning. They're winning top. They're increasing. They're winning market share, increasing their top line, but they're not actually seeing a degradation. They're not selling the product at a lower level. This isn't as though they're winning volume on lower prices. That's the gross margins coming through. It's going positive. It's not even stable. It's going up. I mean, that's just amazing, isn't it? You hardly ever see that. If somebody's growing so much, they're usually having to give a better discount. But these guys, they're not. That's because the technology and the value proposition they offer is so compelling.
Yeah, but fair play. I mean, look at that. From July, it hit £1. I thought we'd go higher. 2, 3, came back down to 80 pence. Then 4 is shot up there, and it went down to 70 pence. Maybe it's time to get out of these now. And then all of a sudden, back up and popped through there, and even come back down. So patience paid there, and it's gone back up again.
I mean, if I didn't hold 30%, if it was back, I wouldn't be selling them because I
know fair play for actually holding when they went down to 70 pence. Because when it gets like a quid, you're thinking, and drops to 70 pence, you think, bloody hell, I'm going to get out. But that's good. That it's fair play. You did hold them. It's
wait and see. Another one in that space which is just worth mentioning is Argentex, and they showed top line like growth of 20%, and the market has sold the shares off. That's because there's some sort of level of skepticism whether they're going to hit their full year of 60 million revenue. I think they did 25 in the first half, so they need to do about 35 in the second half. They've had the whole market for sort of like customer focused and tech enabled forex trade payments and trading as services. It was a soft time over the summer in July and August, but they've started to see a stronger September, and of course there's a big Q4 coming up. So again, I think they are certainly something that is very, very cheap at the moment. I mean, I've got what is that? I think they're trading on it. I can't remember. It was about 12 times or something like 11.4 times PE with plenty of cash in the bank. And I mean, I interviewed all the guys, and they're very confident that the business is moving in the right direction, driven by growth, organic for customers. They're winning market share against the major banks, and their tech-enabled platform that really is accelerating and increasing a share of wallet to those customers. And then obviously they've got geographical expansion out in Europe as well. So I mean, there's all systems go for that business. It's been unfairly sold off, and I think again, if they can deliver their numbers, the execution side, then 2024 will be a really strong period for them. Yeah.
Look at that little gap there. It's amazing how it comes back to that. It's almost like a magnet. So it gapped. Remember that trading update? I bought a few that down here, and I wanted to buy more, and they came up with a trading update. They literally gapped up. Oh my word! They did come back a bit, and I bought some more then. And then I did come out here, and they started rolling over, I think. But it's come back to that level, and I thought,
I know, it's
good.
nuts, isn't it?
The sentiment's down a little bit, and the momentum's against them. But that, like I said, fundamentally, if the business is improving, then that's an opportunity.
You see it a lot with AIM shares because we're still not. I mean, it comes down to what we talked about. First off, if you have UK interest rates now start of top line, they're flattened out. Plus, they're actually going to come down. Maybe say first half of next year. That's going to be a huge sort of like potential catalyst for all small companies because you're going to see multiple expansion. You may not see earnings, increasing more than their current expectations. But you don't need that. If you just get back to a normal level of, valuation multiple, then that will really drive it up. And this one, I mean, it's crazily at 11 times, given the strong, 20% top line growth, static, good, strong margins, generating lots of cash. That's just crazy. 11 times. I mean, you're just joking. It's a crazy valuation.
Yeah. Cool stuff. All right. Anything else, Paul?
No, I think that's probably about it. Any more questions at all we can come in through?
Look,
anything on Intelligent Ultrasound at all?
Well, has it moved? Let's have a look. Let's look at the chart. Someone did say asking about Cornerstone, which is
that's a competitor to, it's a very small version of Equals.
Yeah,
all I would say is that it is definitely interesting, because I've had a quick look at it. It isn't profitable yet, I've got so much money in that sector through Equals, but also I've got PayPal as well. I'm just not going to put another one in my portfolio on fintech payments. No chance.
Yeah, well, I wasn't. I think a guy who worked at Equals, it now works here, doesn't it? Cornerstone.
Yeah, that's.
I think. Yeah.
Yes, I think you might do, actually. You're right.
Yeah. Someone sent them before, and but it's looking quite good at the moment. It's coming down, breaking the trend, it's breaking up. So there we are. But Intelligent Ultrasound, no, it hasn't gone anywhere. It's gone down a little bit. Come on, people! Can't you see what's happening here?
Well, actually, one company I do own that came out with an inline trading update is Eleco, which is worth mentioning. That build tech platform. I think that's another one that people should have a look at. Eleco, it's basically reached again another one with an inflection point. I can really see this one doing well next year in 2024. It's got lots of cash in the balance sheet. You can't see the growth.
That chart.
You can't see the growth because they're transitioning to the SaaS model. But if you looked at it on a like for like basis from sort of perpetual licenses and SaaS and kept them the same, they'd be doing probably, I'm just guessing here, probably low double-digit type growth, certainly high single-digit organic growth, and therefore on that basis, this should be sort of 3 to 4 times sales revenues, because effectively you're selling software, you're selling air, and on that, and they should be a big beneficiary of AI as well, because you'll incorporate it in a better service to be able to improve the product for customers. Plus, you'll be able to reduce your cost base because it will accelerate all your software development. So they're really they're in a good, strong position in my view. They're currently trading at about 2 times sales, I think. So I could see, my price target's 130 on this one. I've held this, as I say, from 2015, so through thick and thin, and it hasn't reached 30% of my portfolio. So I haven't had that problem we've had with Equals. But I would say it's another good quality stock.
Yeah, and it's not. A downtrend has ended there. I mean, downtrending down the low of like 61 pence, but you can see it's bounced up a couple of higher lows here. It wants to break that 84 pence, and once it does, though, that's the resistance. It'll move higher, So it's looking good.
And if you do see interest rates coming down, you will see a lot of their customers starting to do more infrastructure, to do more build, etc., to do project management. So. Yeah, hey, who knows? There's nothing's without risk, put it that way. But it's got lots of cash, and it's growing, and it's got high margins, and it could well be bought by somebody. It wouldn't surprise me either.
Okay, marvelous stuff. Anything else?
No, that's it. That's great. Yeah.
Okay, in a couple of weeks' time, Paul, if there's results out in the company that I've taken a small position on, right, but I think this could be the real deal.
Oh, right. Okay, nice one.
I'm looking around, and I read about it, and the sector it's in, what it's doing, it's very special, because when I look for companies, like, for first of all, size, it's got to be a small amount of cap to move up, but it has got scale, and it is the sector it's in, growing very quickly, and does it have something special? And this company does. And literally, I think it's growing very quickly, but it's not very well known at all. But in a couple of weeks' time, I'm hopefully
You're going to reveal it. Okay, well, we've got lots of good news coming after the next 2 weeks, and that's going to be top of the agenda. That is.
No, let me mention that. I say it's Equals. It's a very good company. No, it's not Equals. It's smaller than Equals, but it's very exciting. Cool. Yeah, hopefully, they've got some results out in a week or so time, and if that looks good, then we'll see from that. Then I may take a bigger position. But there we are. Cool. Thanks everyone, and
Thanks, guys.
join us in a couple of weeks live. Thanks for leaving comments, and don't forget to hit that subscribe button, like it, share it if you like what we're doing here, and we'll do it again sometime. Well, in fact, 2 weeks. Cheers, Paul.
Thanks, guys. Brilliant. We off air now?
We are now.
Okay.
Just after you said it.